Hello friends, good evening to all of you, and today in this video we are going to start with the module D of the BFM. Please do confirm the audio quality at the earliest so that we could proceed. And further, if you have been watching our videos for a while, तो वीडियो को जल्दी से जल्दी लाइक कर देना है एंड फर्दर शेयर कर देना है अपने फ्रेंड्स के साथ, कलीग्स के साथ जो भी CIB की प्रिपरेशन कर रहे हैं फॉर द 2022 एग्जाम्स. सो दिस इज अ हाई टाइम फॉर द प्रिपरेशन. अगर आप आज की डेट से भी प्रिपरेशन को स्टार्ट करते हैं डेफिनेटली यू कैन क्लियर द एग्जाम इन द वेरी फर्स्ट अटेम्प्ट फॉर द श्योर. आपको एक प्रायोरिटी बनानी पड़ेगी, पैटर्न बनाना पड़ेगा, उस पैटर्न के हिसाब से आपको गो थ्रू करना पड़ेगा. अगर आप चाहते हैं कि CIB की सिलेबस प्रायोरिटी की वीडियोस आपको मिले तो आपको हमारे व्हाट्सएप नंबर के ऊपर व्हाट्सएप करना है लिख करके CIB सिलेबस प्रायोरिटी. वी विल बी शेयरिंग द CIB सिलेबस प्रायोरिटी विद यू along with the optional exams priority for the retail and the information technology. तो जल्दी से जल्दी व्हाट्सएप कर दीजिए. लिखना है सिर्फ और सिर्फ CIB सिलेबस प्रायोरिटी. व्हाट्सएप कर देना है टू द नंबर 8360944207. वी विल बी शेयरिंग द लिंक्स विद यू रिलेटेड टू दैट पर्टिकुलर वीडियो. तो ऑडियो वीडियो क्वालिटी को फटाफट से कंफर्म कर दीजिए ताकि आज का जो ये सेशन है इसको हम यहाँ पर स्टार्ट कर पाएं. प्लीज डू कंफर्म द ऑडियो वीडियो क्वालिटी एट द अर्लीस्ट सो दैट वी कुड प्रोसीड. एंड फर्दर वीडियो को लाइक शेयर करना ना भूलिएगा. चैनल को फटाफट से सब्सक्राइब कर लीजिए ताकि जब भी हम कोई नई वीडियो अपलोड करें आपको उसका नोटिफिकेशन मिल पाए एंड डेफिनेटली आप हमारी वीडियोस को गो थ्रू कर पाए. So the audio video quality over here seems to be working very fine. So let's start the session over here. So it is related to question number 8, which says a doubtful up to 1 year has a balance of 20 lakh rupees. The security value is 16 lakh rupees. What is the amount of provision that is to be created? So what will be the amount of provision that is to be created? So a doubtful up to 1 year is having an outstanding balance of rupees 20 lakh rupees and security amount is given over there. And what is the amount of provision that is to be created that we need to answer? So first of all, whenever we talk about the doubtful assets, we need to bifurcate the balances into the secured balances and the unsecured balances. So over here we are having the outstanding balance of 20 lakh rupees. We are having the outstanding balances of 20 lakh rupees and further it is under the doubtful one category. And over here we are having the secured balances of 16 lakh rupees and unsecured balance, that is the shortfall in security, is equal to 20 lakh minus 16 lakh, that is the secured amount, will be equal to 4 lakh rupees over here. And we are well aware that in the case of the doubtful assets, we have to maintain provision at 25% for the secured assets. So it will be 25% of the 16 lakh rupees and 100% of the unsecured balances, that is 4 lakh rupees to be maintained over here and 4 lakh is to be maintained over here. So the total provision that is to be created, it is 8 lakh rupees in this particular case. It is 8 lakh rupees. So option C over here is the right answer, which is already marked over here. Option C is the right answer. But I already told you that what would be the methodology related to solving this particular question. What will be the methodology related to solving this particular question? Is that clear? So option C over here is the right answer. Option C over here is the right answer. Okay. Now let's move to the another question, that is the 9th one, which says a doubtful up to 1 year loan has balance of rupees 20 lakh rupees. The security includes primary security valued at rupees 8 lakh, collateral security value at rupees 8 lakh, third party guarantee net worth 12 lakh rupees. What is the amount of provision in this particular case? So in this particular case, we need to calculate the amount of provision. So what will be the amount of the provision that is to be created? So again, the outstanding balance is given to be 20 lakh rupees. The outstanding balance is at 20 lakh rupees. And further, the secured balance, the primary security is given to be amount to rupees 10 lakh rupees. And further, the collateral security is given to be of the same amount, that is 10 lakh rupees. And we are provided with the third party guarantee over here amounting rupees 12 lakh rupees. So the third party guarantee is given over there, which is having the net worth of 12 lakh rupees. So what would be the right answer over here in this particular case? So we have already discussed in the previous lecture related to that the third party guarantee is not considered, is not accountable for the security part, So we will be considering only the primary security and the collateral security over here. So as for the security part, and that will be 20 lakh rupees. That will be 8 lakh rupees each. So it will be 16 lakh rupees. So the secured part over here comes out to be 16 lakh rupees. It comes out to be 16 lakh rupees, which is the secured part, and again the unsecured part is 4 lakh rupees, that is the shortfall of the securities for 4 lakh rupees. And further, the loan is classified under DF1, so the provision to be created for the secured part is at to be created at 25%, and for the unsecured part it is to be created at 100%. Okay, so 25% of 16 lakh it is equal to 4 lakh rupees, and for the 4 lakh 100% is equal to 4 lakh rupees. So option C over here is the right answer. So option C over here is the right answer. Is that clear? Because we calculated the secured part, and further we get to know, we already know that third party guarantee is not accountable to be under the secured part. So that would be the solution related to it. So Priyanka Tejawat has answered correctly at the earliest. Priyanka Tejawat has answered correctly at the earliest. Next question, it says a doubtful above 1 year account shows a balance of 20 lakh rupees, value of securities is 16 lakh rupees. What is the amount of provision in this particular case? A doubtful above 1 year, what does it mean? It means the account belongs to what category? It belongs to doubtful 2 category. It belongs to doubtful 2 category because it is above 1 year. It is above 1 year. Is that clear? Further over here, the outstanding balance is given to be 20 lakh rupees. Outstanding balance is given to be 20 lakh rupees. And then in that particular case, we are provided with the value of security to be 16 lakh rupees. So value of security is 16 lakh rupees in this particular case. So unsecured part would be of amounting rupees 4 lakh rupees. Now for 16 lakh rupees, the amount of guarantee, the amount of provision that is to be created at 40% because it belongs to DF2 category. So 40% of the provision is to be created, and for unsecured part 100% of the provision is to be created. So 40% of 16 lakh over here, it is 6.4 lakh, and further the 100% of 4 lakh is 4 lakh. So total provision is to be created at 10.40 lakhs. The total provision is to be created at 10.40 lakhs. So the right answer has been given by Rahul Singh Rajput over here. The right answer has been given by Rahul Singh Rajput over here at the earliest. Option C is the right answer in this particular case. Option C is the right answer. Is that clear? Now let's move to the another question, which says a doubtful above 3 years account shows a balance of 20 lakh rupees, value of securities is 16 lakh rupees. What will be the amount of provision? Question number 11. We are provided with the loan amount, which is under the category DF3, and further balance is 20 lakh rupees and the value of security is available at 16 lakh rupees. What will be the amount of provision in this particular case? So Bharani Vasuki has answered correctly, and further Rahul Singh Rajput has also answered correctly at the earliest. So option D over here is the right answer. Option D over here is the right answer in question number 11, because we know that uniformly in the case of the doubtful 3 assets, it is 100% provision is to be created. Whether it belongs to the secured part or unsecured part, 100% of the provision is to be created. So option D over here is the right answer. Option D over here is the right answer. Next question, it says a doubtful above 1 year up to 3 years account has a balance of 30 lakh rupees. The security includes primary security of 10 lakh rupees. CGTMSE guarantee cover of 80% is available. What is the amount of provision that is to be created? What is the amount of provision that is to be created? So we are provided with the doubtful 2 loan category, and further it is having a balance of 30 lakh rupees. So outstanding balance is a 30 lakh rupees, and further we are provided that a primary security is there amounting 10 lakh rupees. Okay, and we are already provided that a CGTMSE guarantee cover of 80% is available. So what amount of provision is to be created in this particular case? We have our first answer over here by Gohila Chandra, that is C, option C over here. Let us do check if it is right or wrong. Okay, so primary security is 10 lakh rupees. So unsecured amount for which the security is not available, it is 20 lakh rupees. It is 20 lakh rupees. And we are aware that a CGTMSE guarantee cover is available of 80%. So for 80% part will not be covered, against which the provision is to be maintained. Okay, so 80%. So 80% of 20 lakh is basically amounting to 16 lakh rupees. For 16 lakh part over here, provision is not to be created, and further the unsecured part is now reduced to 4 lakh rupees. So 20 lakh minus 80%, it is equal to 4 lakh rupees. Now this is the unsecured part. For the unsecured part under the doubtful asset, 100% of the provision is to be created, and further for the secured part, that is 10 lakh rupees, 40% of the provision is to be created. 40% of the provision is to be created, isn't it? Isn't it so? So for the secured part, 40% of the provision is to be created, so it will be 4 lakh rupees. And further for the unsecured part, 100% of the provision is to be created, that is 4 lakh rupees. That is a 4 lakh rupees. Okay, so it will be equal to what? It will be equal to 8 lakh rupees. So the total provision that is to be created over here in this question, it is 8 lakh rupees. So what would be the right answer? Option B over here is the right answer. Option B over here is the right answer. So the right answer has been given by Ashish Mehta at the earliest. So Ashish Mehta has answered correctly at the earliest. So that is the right answer. Option B. Let me explain this to you again. First of all, I just told you that the outstanding balance is 30 lakh rupees, and further the primary security is available for 10 lakh rupees. So the shortfall in security is for 20 lakh rupees, but we are aware that CGTMSE guarantee coverage is available for 80%. For that, the provision is not to be created. So that amount is to be subtracted, and we left with the unsecured portion of 4 lakh rupees, for which 100% of the provision is to be created. And for the secured portion of rupees 10 lakh, we have to create the provision at 40% because the loan is categorized under DF2, okay, doubtful 2 category. So over here, the total provision that is to be created is 8 lakh rupees. So option B over here is the right answer. Question number 12. Option B over here is the right answer in this particular case. Is that clear? Now let's move to the next question, which says a doubtful up to 1 year account has a balance of 40 lakh rupees. The security includes primary security of 10 lakh, collateral security of 10 lakh, ECGC guarantee cover of 60%. What is the amount of provision that is to be created? So we are well aware of the concepts now. So kindly please do answer at the earliest. So doubtful up to 1 year account has a balance of rupees 40 lakh. The security includes the primary security of 10 lakh rupees, collateral security of 10 lakh rupees, ECGC guarantee of 60% is available. So outstanding balance is of amounting 40 lakh rupees, and out of these 10 lakh of the primary security is available, and further 10 lakh of the collateral security is available. So the shortfall in the security is for 20 lakh rupees, and we are having the ECGC guarantee cover of 60%. So 60% of the part is basically that part for which provision is not to be created, and only for the 8 lakh rupees over here. Only for 8 lakh rupees over here, we will be creating the provision at 100% because it belongs to DF1 category. So 100% provision for the unsecured part, and it will be equal to 8 lakh rupees. And further for the secured part, we will be creating the provision at 25%, which will be amounting to 20 lakh. 25%, it is equal to 5 lakh over here. So the total provision that is to be created, it is to be created at 13 lakh rupees. So answer over here is option B. Option B is the right answer. So Rahul Singh Rajput has answered correctly at the earliest related to this question. So option B is the right answer. Option B over here is the right answer in this particular case. Is that clear? Is that clear over here? Okay. Next, it is related to banks are required to maintain an overall provision coverage ratio of. So overall provision coverage ratio of what percentage is to be maintained by a bank? So provision coverage ratio is equal to provision. It is basically ratio of provision to the gross NPA. Okay. So this is a provision amount that is to be created. This is a PCR, and what is the right answer? It is option C. So banks are required to maintain an overall PCR at 70%. And overall PCR at 70% is to be maintained. So option C over here is the right answer. Option C over here is the right answer. So that would be all related to particular this unit. So now let us start with the next unit, which is related to the liquidity management. which is related to the liquidity management. So kindly please wait for a minute so that I could open the file over here. So we already know that banks do face the liquidity risk, and whatsoever the financial tasks are undertaken by the banks do basically face the liquidity issues related to those. And further, it's the prime responsibility of the management so as to deal with those. Okay, let us have first of all look at the liquidity management, that what are the objectives related to that. First of all, it is related to ensuring the profitability, because if we are matching the liquidity gaps, it is basically that we can do fund for our liabilities from the assets at the reasonable price, and also we can do ensure the liquidity. That is a responsibility, that is the obligation of the bank, so as to ensure the liquidity, whether it is for the lending purposes, whether it is for repaying the obligations. Okay, so for those purposes the liquidity is required, and that is the main objective of the liquidity management, so as to ensure the profitability and ensure the liquidity. Okay, so liquidity is represented by what? It is represented by the quality and marketability of the assets. Okay, so let me tell you one thing first of all, that assets are sources of receipts, because from assets we will be receiving the amounts and liabilities that are to be paid off. In case of the banks, what are representing the assets? Definitely the credits are representing the assets, or we can say the investments are representing the assets. Whether we have lent money or whether we have made the investment, that is related to the asset part. And what it relates with the liability, that the amount which is to be paid off, whether we have borrowed the amount in the interbank market or we have basically accepted the deposits from the public, those are to be repaid, and those are the obligations on the bank. And liquidity, which is related to, it is basically represented by the quality and marketability of the assets and liabilities that are exposing the organization to the liquidity risk. Because if an obligation arises over there, that is to be paid from the assets itself, because the liability is related to the payments, whereas the assets are related with the receipts. On the maturity of the assets, we will be receiving the amount. Or we will be creating fresh liabilities. So as to pay off the maturing liabilities. Are you getting my point? Either we are having the cash in hand or the balances with us, by which we can pay the amounts related to the liability, related to the obligations, or we can do one thing, we can basically take fresh liabilities from the market itself and can pay off our previous liabilities or maturing liabilities. Okay, so liquidity risk is normal aspect of everyday management. For a financial institution, because whensoever we are dealing with the financial assets, it is basically related to what? That we have invested our money. So whatsoever money that was received by the banks in the form of deposits, in the form of borrowings, that was invested by the banks. Okay, now it may be the case that the depositors or the borrowers who lent the monies to not the borrowers, the lenders who borrowed the money to us, they basically demanded the money in between, and it may arise a risk. It may basically put the bank, it may expose the bank to the risk related to the liquidity. Okay, so only and only under the extreme cases of the liquidity risk problems that translate it into the solvency risk problems. Risk problem is arose only and only in the extreme cases. Is that clear? Now let us have a look at the definition of it. So banks need liquidity to meet deposit withdrawals. The banks need liquidity to meet the deposit withdrawals. So whensoever the deposits are demanded by the public, which they have deposited with the bank, or those are withdrawn by the customers itself, and further so as to fund the loan demands. Let us take the case that you have sanctioned a CC limit amounting rupees 4 crore to a person A. Now person A demanded the money out of the loan amount. In that case also you need the funds. Okay, so the variability of the demand and variability of the deposit basically determines the bank's liquidity needs. What money do I need? That basically depends upon the variability of the demand and variability of the deposits. Is that clear? So bank has adequate liquidity when it can obtain sufficient funds, by increasing the liability. That part I already explained. By even we can basically fulfill our liquidity needs now by either by basically obtaining the sufficient funds by increasing the liabilities, or we can do increase our liabilities and can pay off the present obligations. That is the case. Or it may be the case that we can do convert our assets by selling the assets, at some reasonable cost. Okay, so if we are able to match the payments that is related to the obligations, either by increasing the liabilities or by converting the assets, in that case we can say that we are having adequate liquidity. Okay, so if liquidity needs are not met through the liquid asset holdings, so if liquidity needs are not met through liquid asset holdings, bank may be forced to restructure or acquire additional liabilities. What does it mean? It means, let us take the case that over a 1 month horizon, time horizon, the maturing assets are amounting 100 crore rupees, and further the maturing liabilities are 130 crore rupees. Okay, in that particular case, bank is either to convert the other assets which are not maturing in the term of 1 month, so as to convert those assets into the liquidity so as to pay off the obligations, or the other case it could be that the bank may be forced so as to borrow another amount of money from the market so as to bridge the gap over here. Is that clear? And for the dimensions and role of liquidity risk management, let us have a look at the dimensions and role of liquidity risk management. So banks liquidity risk management is a process of generating funds so as to meet the contractual or relationship obligations at reasonable price at all the times. So what is a management related to liquidity? That we want adequate liquidity so as to match our obligations, from either creating the new liabilities or by converting the assets at reasonable price. Okay, so that is related to liquidity management. So effective liquidity management by banks serve important functions. What are those? It demonstrates the marketplace that the bank is safe. So if you are having adequate liquidity, basically it fosters a trust of public in you, that you are capable of repaying your borrowings, and further it enables banks to meet its prior loan commitment. Okay, we can meet our prior loan commitments, and further it enables banks to avoid unprofitable sale of assets, because if we are not having adequate adequate liquidity, in that case, as we have already discussed, that the bank will be forced so as to sell the assets at unreasonable prices or unprofitable situation. Is that clear? And option D, statement D over here, it says it lowers the size of the default risk premium the bank must pay for funds. So whensoever the liquidity risk arises, the bank is out of liquidity, the bank resorts to the interbank market. The banks resort to the interbank market either for the call money or for the notice money. In that particular case, the other banks do lend the money to the borrowing bank, but if the bank is a defaulting bank, in that case, more of the risk premium will be charged to that particular bank. So let us take the case that the bank A is out of the liquidity and bank A resorted to the money market over here or interbank market over here so as to borrow the money from the interbank market and further so as to fulfill the obligations. But now if bank A over here is defaulting in the case that it was not unable to meet up with its obligation at earlier also, in that particular case it will be have a negative image and more risk premium will be charged. Okay, further, adequacy of bank's liquidity position depends on the analysis of what factors. First of all, adequacy we can determine from what factors, that what was the historical funding requirement, what is the current liquidity position, what would be the anticipated future needs. Okay, what would be the anticipated future funding needs? So what we were basically demanding in the what were our requirements in the past, what we require right now, and further what we may be requiring in the future itself. Those all are the factors. And other than that, sources of fund. What is our source of funds? At would it be reasonable? Would it be available at reasonable cost? And further, options for reducing the funding needs. How we can do reduce our funding needs, and further, present and anticipated asset quality over there, because asset quality does matter a lot. Because if you are having if you are having the deteriorating asset portfolio, in that particular case you will not be able to convert those assets into receipts, and ultimately that will basically increase the asset liability mismatch, and further it will adverse the situation of the liquidity risk. Are you getting my point? Okay, so let us take the case that you were to receive 100 crore rupees in the next 1 month, but due to the deteriorating quality of the assets, you are not able to receive that particular amount of money. In that case, we can infer what? We can infer that we are basically having the adverse situation related to the liquidity. So that is also a factor related to it. Further, present and future earning capacities, and present and planned capital position. So these are the factors related to the adequacy of bank's liquidity position, So as all banks are affected by changes in the economic climate, the monitoring of economic and money market trends is a key to liquidity planning. Why it is so? Kindly please read this line again. The monitoring of economic and money market trends. Why it is so? Because if more of the banks are borrowing from the money market instrument, in that case, what does it mean? That there is a situation related to economic slowdown, or it may be the case, it may be such an adverse situation that the public do not trust in the banks more, and further they are withdrawing more money from it. Okay, so that it is related to. So we must be monitoring the economic and money market trends over there. So some factors that may affect a bank's liquidity, what are those? That is, first of all, it is related to a decline in earnings. It may be the case that you have increasing non-performing asset. It may be the case related to deposit concentration. How it does relate? Let us take the case you are having 500 crores of the deposits, and out of these 500 crore of deposit, your maximum part of the deposit is coming from the single person, amounting rupees 200 crore. Now let us take the case that this person withdrawn the amount. In that case, it will largely increase your funding demands. Because there was deposit concentration. And further, your funding demands will now be increased. And further, these are to be looked into. Is that clear? Is that particular part clear over here? Okay, now let's check it further related to the downgrading by rating agencies. It may be the case that your rating has been downgraded. It may be the case that expanded business opportunities are there, due to which you require more funding. If you're lending more and more, in that case also you require more funds. And it may be related to acquisition, that you have acquired some subsidiaries or some other companies, that is why you require more funds. It may be the case related to new tax initiatives are there, due to which you are not complete your funding requirements and you require more funds. So factors that may affect the bank's liquidity, those are related to this, and further we have covered them. To provide funds to satisfy the funding needs, a bank must perform one or the combination of the following. So what is to be done so as to fulfill the funding needs? First of all, dispose of liquid assets. So whensoever you need the funds, there is a shortfall of funds, that there is a negative mismatch or negative gap of the assets and liabilities. What does it mean? That a negative gap of assets and liabilities, it is a relation where your liabilities are greater than assets. Then in that case, it is said to be negative mismatch. We are talking about the residual maturity of the assets and liabilities which are maturing over a time horizon. Okay, if data is basically liabilities are greater than assets, and in that case it means that there is a negative mismatch, And further, that gap can be fulfilled if you if you dispose of your liquid assets. Let us take the case, I was having some investments which I can pay off at a very low haircut. Okay, in that case, I must be disposing of. And further, increase short-term borrowings. I already told you that we can increase the liability side, or we can decrease the holdings of less liquid assets. We can decrease the holding of the less liquid assets. That can also help us to so as to fulfill the gap. And further, increasing liabilities of a term nature. Increasing liabilities of term nature. If you're lending amount for a term nature, if you're basically not increasing liabilities, basically not related to lending, if you're basically accepting deposits of long term types. Okay, let us take the case that we are accepting the deposits for 3 years or for 5 years. In that case, your residual maturity will be for more time, for longer time horizons. Okay, in that case, your residual maturity will be for the longer time horizons, and it will definitely decrease your funding needs. Is that clear? And fifth one, it is related to what? It is related to increasing capital funds. That if owned funds are increased, in that case also you are having more funds with you. Those can be utilized so as to fulfill the gap. Then it is related to types of liquidity risks. So liquidity exposure can stem from both internally and externally generated factors. So there can be internally generated factors or externally generated factors. It can be due to geography, systemic, or the instrument specific, or these may be having related to the internal liquidity risk that relates with the largely to the perception of institutes in its various markets related to local market, regional market, national market, or international market. This is not actually related to the types of risk. It is basically related to the external and internal factors. It is related to the internal liquidity factors and for the external liquidity factors due to which the risk is there. And for the other categories of the liquidity risk are, it is first of all related to the funding risk. So funding risk is related to what? Need to replace net outflows due to unanticipated withdrawal. Let us take the case that the person who deposited the money with you, he basically withdrawn the money. He used the embedded option with it. So he basically withdrawn the money, or there is non-renewal of deposits, or there is non-renewal of deposit. In that case, that will basically lead to the funding risk. And what are the different scenarios due to which this situation arose? It is the first case, fraud causing substantial loss. If there is a fraud in the bank itself and there is a substantial loss, in that case you require the different funds. If it may be the cause related to the systemic risk. So under the systemic risk, we have already covered that one bank in a way or another is related to the other bank. Okay, in that case, if there is failure of one bank, that will lead to the failure of other bank also. Okay, that will basically increase to the unanticipated withdrawal. That will basically increasing the unanticipated withdrawal, and further definitely lead to what? Definitely that will lead to the funding risk. It will be related to that public has lost their confidence in the banking sector itself. So public will not be depositing more money with the bank, and further they will be withdrawing the money and unanticipated. And liabilities in foreign currency. If you are having the liabilities in foreign currency, in that case you have to match the gaps for the different currencies. Is that clear? Then it is related to time risk. So need to compensate for the non-receipt of the expected in cash inflows of the funds that will basically arise the time risk. Now let us take the case that you were to receive term loan installments. Amounting rupees 2 crore rupees. But you received only 50 lakh rupees of the installments. That is basically due to which you are not able to fulfill the obligations related to the funds. So the liquidity risk arose over there due to the fact that you were to receive 2 lakh rupees, but the assets became non-performing assets, and further you are not able to receive those funds over there. That is basically related to the time risk. Okay, so that can be due to the severe deterioration in the asset quality, or it may be the case that the standard assets have turned into the non-performing assets. It may be related to the temporary problems in recovery. It may be related to the time involved in managing the liquidity. Okay, So that is related to the liquidity risk. Next, it is related to the call risk. Call risk arises due to the crystallization of the contingent liabilities. So when the contingent liabilities arise, likewise, if the bank was dealing in the derivatives of the options, in that case particularly, or we can also learn it from the different scenarios. Let us take the case that the bank has basically issued a bank guarantee. The bank has issued a bank guarantee that was related to what? That was related to contingent liability, which may crystallize in the future. Now, if that particular guarantee crystallized in the future, the bank will be requiring additional funds. The bank will be requiring the additional funds so as to fulfill their obligation under the bank guarantee. Under the bank guarantee. So that will lead to what? That will basically lead to the call risk. That will lead to the call risk. Is that clear? That will basically the conversion of non-fund based limit into the fund based limit, and it may be due to the swaps and options too. So many times more than one factor manifest and make the liquidity situation worse. It is not the case that all the risk will be arising independently. It may be the case that it's a complex structure of all these types of risks. Okay. Further, it is related to measuring and managing liquidity risk. Measuring and managing the liquidity risk. So measuring and managing liquidity risk are the most vital activities for the commercial banks. These are the most vital activities for the commercial banks because we need to quantify the risk first of all, and further we need to manage liquidity risk so that that risk is under our appetite so that we can manage that particular risk. Okay. So in particular, good management information system, central liquidity control must be there, analysis of net funding requirements, very, very important. So we must be basically look at the factor related to net funding requirement, that what is our net funding requirement, and further we must be having the diversified sources of funds. And further there should be contingency planning. There must be the contingency planning related to it. So diversification of the related funds must be there, and contingency planning related to the crucial elements must be there, so that those all indicate what? Those all indicate the strong liquidity management. If you are adhering to all these, if you are basically analyzing the net funding requirements, if you are resorting to the diversification of the funds or diversification of the funding sources, if you are having the contingency planning, if you are having the good management information systems, in that particular case you can have a strong liquidity management. Okay. Further steps necessary for managing liquidity risk in bank. What are these 3 steps? Let us have a look at it. First of all, it is related to developing a structure for managing liquidity risk. It is related to developing a structure for managing the liquidity risk. Second, it is related to setting the tolerance level and the limit for liquidity risk. Third, it is related to the measuring and managing the liquidity risk. First point that we'll be covering for the steps, those are related to manage the liquidity risk, that is developing a structure for managing the liquidity risk. Now, whenever we talk about the structure, that is related to hierarchy and also the policies and procedures. Okay. So sound liquidity risk management involves in setting a strategy for the bank, ensuring effective board and senior management oversight, as well as operating under a sound process for measuring, monitoring and controlling the liquidity risk. So structure means what? That the board of directors, the senior management must be having an oversight, that they basically look at the net funding requirements, and further they must be having a sound process so as to quantify, so as to monitor and so as to control the liquidity risk. That is related to further bank's liquidity policies and liquidity management approach form a key element. So related to the liquidity policies and further the liquidity management approach, these are the key elements related to the general business strategy. So we must be understanding the context of the liquidity management, that involves examining a bank's managerial approach, that there must be a managerial approach, that we want to match the liquidity, we want to match the funding demands over there, and further there must be appropriate planning in that particular case under the alternative scenarios. So there can be alternative scenarios under which the liquidity demand may alter, the liquidity demand may be variable. In that case, you must be considering all of those different scenarios, and planning must be there related to those. And the liquidity strategy should be set out the general approach of the bank, that what would be the general approach of the bank for related related to the various quantitative and qualitative target. That what will be our quantitative and qualitative target related to that, how we will be basically dealing with the liquidity management, how we will be dealing with the liquidity management, and there must be a general approach related to that. The strategy should also address, so whatsoever the strategy is there, that must also address the bank's goal of protecting the financial strategy and the ability to withstand the stressful events in the marketplace. So the strategy is not only related to the normal situations, it is not only related to the normal situations, but it also may address the adverse situations in the market. So whatsoever the adverse stress situations that may arise in the market, those may also be looked into, those may also be addressed under our policies, So it should be communicating the specific policies on particular aspects of liquidity management related to what should be the composition of assets and liabilities. Okay, first of all, we are having a general approach related to it, then it is related to the specific policy, that what should be the composition of the assets and liabilities, and further the cumulative gaps that must be maintained, the maximum cumulative gaps that can be maintained for the residual maturities. That particular part we have already covered. We have covered with an example in the previous lecture. That was related to what? Let us take the case that you are having the liabilities and assets for a time horizon of 1 month, and we are talking about the residual maturities. We are talking about the residual maturities of the assets and liabilities. In that particular case, let us take the case that the assets and liabilities are 100 crore is a liability and 50 crore is the asset. In that particular case, it is classified that for the different terms. Let us take the case for 1 day, for 2 days to 7 days, for 8 days to 15 days, or so on. There must be cumulative mismatch. The negative gap should not be over and above some particular limit that it is related to. Okay, so those should also be managed related to it. And further, approach to manage the liquidity in different currencies and from one country to another, that should also be specifically classified under the policies. Okay, so there must be specific policies related to the composition of assets and liabilities. There must be related to the cumulative gaps that can be maintained at the maximum, and further it is related to the managing the different currencies and related to the one country to another. Okay, the strategy of managing liquidity risk should be communicated throughout the organization. It is not related to one tier process. It must be communicated throughout the organization. All the business units with the bank that conduct the activities having an impact on the liquidity. So whatsoever the business department, whatsoever the business units which are conducting the different activities, and further those are having the impact on the liquidity of the bank, those must be aware of this liquidity strategy, and further those must be operating under the approved policies and procedures. So whatsoever the approved policies and procedures which have been approved by the board of directors and the senior management, those must be kept in mind by the full organization. Those are dealing with those activities which are impacting the liquidity status of the bank. Is that clear? Then the board should monitor the performance of the liquidity risk profile of the bank. Only and only just articulating the policies and procedures is not adequate. The board must be looking into the factor. The board must be monitoring the performance of the liquidity risk profile of the bank, and there must be periodic review of that too. There must be periodic review of the that too. Then it is related to bank should have liquidity management structure in place to execute effectively the liquidity strategies, policies and procedures. So whatsoever the liquidity strategy we are having the different approaches, the different policies and procedures which have been articulated by the board of directors. The bank must be having some structure in place. The banks must be having some structure in place so as to execute them effectively. The responsibility of managing the overall liquidity of the bank. The responsibility of managing the overall liquidity of the bank should be in place with the specific identified group within the bank. With the specific identified group within the bank. Is that clear? Okay. So we are talking about the asset liability committee over here, that is related to the ALCO over here, the treasury function of the risk management department. Then it is related to treatment of the foreign currencies. So what we read in this particular point over here, the first point, it is related to what? It is related to developing a structure for managing the liquidity risk. So in simple language, I can say you that board of directors and further the senior management and further the senior management, though are basically they are basically there so as to articulate the different policies and procedures, and further there must be some structure through which these can be executed effectively, is that clear? Further, it is related to managing the foreign currency, treatment of the foreign currency. So for the banks with an international presence, the treatment of assets and liabilities in multiple currencies add a layer of complexity. Okay, so that it is related to. So let us take the case, if you're dealing in INR only, Indian currency only, you are having the assets and liabilities in Indian currency only. But let us take the case that you are also dealing in the foreign currencies. Let us take the case you are dealing in USDs also. In that case, you will be having the residual maturities of the assets and liabilities in USDs too. So you have to manage these liabilities and assets that is related to inflows and outflows of the foreign currencies too. So that basically adds a layer of the complexity in that particular case. Okay. So first, banks are often less well known to liability holders in the foreign currency markets. Second, in the event of disturbance, a bank may not always be able to mobilize domestic liquidity to meet the foreign currency funding requirements. Is that clear? So if there is an adverse situation, the bank may not be under the position so as to mobilize the domestic liquidity, so as to meet the foreign currency funding requirements. Is that clear? So that is the point that is related to that there must be treatment of the foreign currency in such a way that we basically meet the asset liability mismatch under the different currencies. Okay. So it is related to two key decisions. So when bank conducts its business in multiple currencies, its management must make two key decisions. What are those two key decisions? Let us have a look at it. First decision concerns the management structure. A bank with funding requirements in the foreign currencies will generally use one of the three approaches. Let us have a look at those. So first of all, it may completely centralize the liquidity management. At the complete of the whole of the organization. The complete structure, the complete liquidity shall be managed at the head office only. That is the first approach. And the second approach, it is related to that it is a decentralized handling of the related to the liquidity management. That there will be decentralized liquidity management. How that can be done? That it is related to that the different operating divisions are there. So those all will be individually managing the liquidity risk for them. Those all will be managing their own liquidity risk. Is that clear? They all will be managing their own liquidity. That is related to decentralized management of the liquidity. And in routine they will be reporting to the head office. And further in routine they will be reporting to the head office. That is a second point. That is a second approach. And the third approach, it is related to that a bank may assign the responsibility for the liquidity in home currency and overall coordination to the home office. So in the case we are dealing with the INR, the overall responsibility with the home office, that is the home head office. And further related to the foreign currencies, the responsibility related to, let us take the case example of the USD. In that particular case, related to the responsibility of managing the USDs, that will be lying with the department in the foreign country itself. So let us take the case that there is a same bank which is having branch in USA and head office is over there. So that will be assigned the responsibility so as to manage the liquidity related to USDs. Is that clear? So that is the third approach. The second decision, so the first decision was related to management structure. The second decision is related to concerns the liquidity strategy in each currency. It is related to liquidity strategy in each currency. In the ordinary course of business, a bank must decide how foreign currency funding needs will be met. The second decision is related to the liquidity strategy. That is basically related to that from where we will be meeting up the foreign currency demands. Okay, from where we will be basically meeting up with the foreign currency fundings. Okay, and further, to what extent will a bank fund foreign currency need a domestic currency so as to compete up our foreign currency needs, with our foreign currency needs, up to what extent we need the domestic currency, up to what extent we need the domestic currency, and further convert the proceeds to foreign currency. So as to convert the proceeds to foreign currency through the foreign exchange market or currency swaps. Okay. So first it is related to from what sources or how the foreign currency funding's need will be met. That is related to the first thing. And second, it is related to what extent will a bank fund foreign currency need in domestic currency so that we can convert that domestic currency into the foreign currency. Is that clear? And further, how will a bank manage the associated risk? How the bank will be managing the associated risk with the foreign currency if the exchange markets cease to be available. If the exchange market cease to be available, let us take the case if the domestic, we are not able to convert the domestic currency into foreign currency. In that case, how we will be meeting up with our with the funding over there? That is a related case. And further, bank must also develop a backup liquidity strategy. So that is a strategy related approach. And further, bank must also be having a backup liquidity strategy for circumstances in which its normal approach to funding foreign currency operation is disrupted. Let us take the case if everything is normal, it may meet up with its funding requirements in the foreign currency. But if it is an adverse situation, in that case, how it will be dealing with it, that strategy must also be looked into and must be developed. Is that clear? Second point, it was related to setting tolerance level and the limit for liquidity risk. Second point, it was related to the setting tolerance level and limit for liquidity risk. We were covering the 3 points over here. Let me remind you over here that we were covering the 3 points related to the steps necessary for managing the liquidity risk. So first point we covered so far, that was related to developing a structure for managing the liquidity risk. So we covered related to the structure, related to policies, and also we covered related to how we can manage the foreign currencies. Okay. Second, it is related to the setting tolerance level limits for the liquidity risk. So let us have a look at it now. Okay. So banks management should set limit so as to ensure the liquidity, and these limits should be reviewed by the supervisors. Okay. So as to reduce the funding requirements, so as to reduce the gap, the limits must be there, and these limits must be reviewed by the supervisors. Okay. First of all, it is related to cumulative cash flow mismatches. Cumulative cash flow mismatches that we have already covered. Those mismatches gap must also be limited. So there should be a limit related to it. Second, it is related to liquid assets as a percentage of short-term liabilities. Liquid assets as a percentage of a short-term liabilities. Okay. So whatsoever the liquid assets you are having, so that must be a percentage of the short-term liabilities must be covered, because short-term liabilities are to be met up at the earliest. These are to be met up at the earliest. So you must be having the high liquid assets which are highly liquid, that is readily convertible, and further you can met up the liabilities that must be there. And further, it is related to a percentage of these to be maintained against the short-term liabilities. Let us take the case that your short-term liabilities are 100 crores. In that case, if it is prescribed by the board that you must be having the liquid assets amounting rupees 30%, in that case you must be maintaining the 30 crores of the liquid assets with you. You must be maintaining the 30 crores of the liquid assets with you. Is that clear? And further, a limit on loan to deposit ratio, that how much amount of the loan can be sanctioned against the deposit, that ratio must be there. A limit on loan to capital ratio, that what amount can be sanctioned against the capital, that ratio limit can also be fixed. And further, a general limit on the relationship between the anticipated funding needs and available sources for meeting those needs must be there. So relationship related to what is our anticipated funding needs and further available sources, that limit can also be maintained so as to meet up with those needs. And further, primary sources for meeting the primary needs should also be quantified, that if there is a rising funding risk over there, in that case what would be our primary sources from where we will be meeting up with the liquidity risk, that can also be considered. For the flexible limits on the percentage reliance on particular liability, so there should be a flexible limit that on what part we can basically rely on one particular case. Let us take the case that you are having the certificate deposits amounting rupees 1,000 crores. It should not be the case that you are relying on only and only those certificate deposits so as to cope up with your liquidity needs. Okay, so there must be some percentage limit that you are relying on one source, It is due to the fact that if the single source you are relying on and further you are not able to liquidate from that particular source, you'll be having adverse situation, and that can also lead to insolvency. Further, limits on the dependence on individual customers. So there must be not dependence on the individual customers. Let us say the case that we are having the residual maturity. We are covering the data related to 1 month of the residual maturity, and your residual maturity assets are 100 crore rupees, and further your liabilities are 80 crore rupees. But out of these 100 crore rupees, the loan amount which is having residual maturity for 1 month, it is the single person, which is A over here, which whose loan is expiring amount, who is basically maturing amount rupees 50 crore rupees. What does it mean? It means that you are going to receive 50 crore out of this 100 crore from person A only. So what if the single person defaulted over here? In that case, there will be arising the funding risk. So there should be flexible limit related to those. And further, limits on dependence on the individual customers that we have already covered. Further, it is the flexible limits on maximum and minimum average maturity of different kinds of liabilities. So there must be a flexible limit related to minimum and maximum average maturity of the different categories of the liabilities. For the minimum liquidity provision to be maintained to sustain the operation. So minimum liquidity provision that is to be created so that you can sustain the operations. These guidelines, these limits or tolerance limits must be fixed. These must be fixed. Third, it is related to measuring and managing the liquidity risk. But that point will basically we'll be covering in the next video. So that would be all related to this particular video. So वीडियो को फटाफट से यहाँ पर लाइक कर दीजिए एंड फर्दर रेट कर दीजिए आउट ऑफ 10 एंड एक स्माइली आइकन डाल दीजिए इफ यू हैव बीन लाइकिंग अवर वीडियोस. वीडियो को लाइक एंड शेयर करना बिल्कुल ही फ्री है. यूट्यूब वालों ने ये फीचर अभी तक तो फ्री दिया हुआ है, तो उसका जम के यूज कीजिएगा. फटाफट से वीडियो को लाइक कर दीजिए, शेयर कर दीजिए. एंड इफ यू वांट टू एनरोल इनटू अवर कोर्सेज यू नीड टू विजिट अवर वेबसाइट iibf.info, जहां पर आप फुल कोर्सेज को एनरोल कर सकते हैं. यू नीड टू विजिट द वेबसाइट iibf.info. एंड हमारा एक ऑफर चल रहा है, दैट इज बेसिकली ईद के ऊपर हमारा ऑफर है, जहां पर आप अगर कूपन कोड यूज करते हैं ईद मून, तो आपको फ्लैट 80% ऑफ मिल जाता है ऑन द प्राइजेस. यानी कि जो मैक्सिमम प्राइस है उसके ऊपर फ्लैट 80% आपको मिल जाता है. तो फ्लैट 80% को आपके लिए कल की डेट तक यानी कि 3 मई तक ये ऑफर अवेलेबल रहेगा. सो जल्दी से जल्दी विजिट कर लीजिए एंड फर्दर स्टार्ट प्रिपेयरिंग फॉर द सेम. सो फटाफट से एनरोल कर लीजिए एंड फर्दर स्टार्ट कर दीजिए अपने प्रिपरेशन को. सो दैट वुड बी ऑल रिलेटेड टू दिस वीडियो. थैंक यू सो मच एंड सी यू अगेन इन द नेक्स्ट वीडियो एट 8:15 PM related to ABM. So that would be all. Thank you so much and see you again.